Hello everyone, this is Brad from Outcast Trading. Today is January 1st, 2019, and today's topic is all about QT. So you might be asking yourself, what is QT? Well, QT is quantitative tightening. QT is what the Federal Reserve does when it actually destroys money. It's the opposite of QE, and today we're going to talk a little bit more formally, presentation style instead of podcast style, I guess. Um, so let's just get into it. All right, so what is QT? QT is quantitative tightening, as I mentioned earlier. It's the opposite of QE. In this case, quantitative tightening is a tool used by the Federal Reserve as a gradual runoff schedule, starting with $10 billion per month and then ending with $50 billion per month. So, what does that really mean? Uh, Quantitative tightening started with the schedule in Q3 2017 at $10 billion per month. It progressed to 20 billion in Q1 2018, and as you can see from the schedule here, it accelerated with 30, 40, and 50 billion dollars, where it's going to remain at. So basically, the Federal Reserve wanted to ease into the destruction of money. And if you don't know, quantitative tightening is when the Federal Reserve actually destroys money instead of creating money. So in the 2007-2008 financial crisis, quantitative easing was the creation of uh, trillions of dollars. We went from $900 billion in 2009 all the way up to nearly actually just over $4.5 trillion, somewhere around the 2015-2016 years. And we actually, when we started tightening, we were just under $4.5 trillion in October of 2017. So what you're seeing here is the schedule that the Federal Reserve has stuck to somewhat, but this was their initial schedule that they proposed and started to implement in Q3 2017 through today. And as you can see, the schedule was, again, to start at 10 billion, work all the way up to 50 billion, stay at 50 billion in 2019 and 2020 months. So we're going to see a projected $600 billion runoff in 2019 and another $600 billion in 2020. But the total expected runoff by today is by January 1st, 2019, is supposed to be 450 billion. Now here is what's interesting about that. Here is a snapshot of Fred, and this is the Federal Reserve Economic Data's website. This is the Federal Reserve's own website showing from October of 2017, and you could see that it was at $4.46 trillion on October 4th, 2017. And the breaks aren't perfectly on October 1st, but if you're wondering, the previous week, which was in late September of 2017, was actually $5 billion lower than what we're showing here. So this is $4.46 trillion, or 4,460 billions. And what we can see here is that we started at 4.460 trillion, and we're down to 4.075 trillion today. So that's a $385 billion runoff, well short of the $450 billion that the Federal Reserve promised. So here's what's interesting about that. What's interesting about that is that they haven't met their target. And with all the excitement and with all of the complaining on CNBC and Bloomberg and all the financial channels, isn't it interesting that they're, what, roughly 25%, a little over 25% short of where they should be? Interesting. So 65 billion short of where they should be. Sorry about that. That's about a 15% shortfall, not 25%. But you get the point. We're well short of the original runoff target, and we are not staying on schedule, even with the projected rundown of nearly $3.5 trillion that was added between 2009 and 2013 with the various waves, with the three waves of QE. So what does that mean for us going forward? Well, I think what this means for 2019 is that the Fed is in a no-win situation with the dollar. So I have DXY up there. That's just simply the ticker symbol for the U.S. dollar index. You can view the U.S. dollar index, which is a basket of currencies that's measured against the U.S. dollar to basically weight and gauge the strength of the U.S. dollar. So I think the Fed is in a no-win situation because if they halt QT, the dollar's going to fall in 2019. And I think if QT continues, the dollar's also going to fall because instead of simply halting QT and tipping their hand that a recession is inevitable and that the dollar is going to get weaker, as opposed to a weaker U.S. economy and then a strengthening set of currencies against the U.S. dollar, thereby making the dollar weaker, I think you're going to see the same thing with just simply stock markets fall. So either way, I think the Fed is in a bind. I think precious metals is going to benefit tremendously, particularly silver. And I think, going forward, we're going to see a lot of really interesting dynamics that are going to help precious metals. Um, so I think, as we continue to look at the Federal Reserve's work off of their balance sheet, their reversal of all the money that they created to basically backstop the banks. And again, if you don't know, quantitative easing was basically set up to print all this money to backstop the banks and to also smooth over and backstop all the bad bets that the banks had made up to that point. So the banks needed liquidity for two reasons. It was to make some of their investors whole and to shore up themselves against making those investors whole because they had holes in their balance sheet. But it was also to shore up their balance sheet from further liquidity drains and panics and crises in terms of liquidity. So now what we're seeing is the unwind of that, and the banks are ultimately going to see less money. Although, it's a little hilarious because we started at 900 billion in 2008 with the various waves of QE. We ended up at 4.5 trillion, but the Federal Reserve is still anticipating being at 2.5 trillion, which is roughly 3 times the size of where we started in 2008. So it's a bit laughable that everyone is getting so exercised by the fact that the Federal Reserve is only going to be 3 times higher than it was a decade ago in terms of a massive balance sheet. So the fact that we're going to see still a really big balance sheet, but we're going to work off $2 trillion and oh my gosh, the markets might fall another 10, 20, 30% as a result of that here in the next 6 months. But it is a concern because you are seeing a lack of liquidity, you are seeing things tighten up quite a bit, and you are seeing some panic enter the market, even though we've only worked off 385 billion on 4.5 trillion. So we're not even 10% into a reduction of the Federal Reserve's balance sheet. We're already seeing a lot of panic. We're already seeing, up until the Santa Claus rally that we just this week in the markets, we had a 15% decline. So, now we're a little bit better because, the Dow, for instance, is up, a couple thousand points roughly, in the Santa Claus rally. But I think we're going to still see more pressure on the Dow. And again, I would be surprised to see the Dow above 20,000 at the end of 2019. Now, that said, all of this is my opinion. This is not investment advice. This is just one guy on the internet who's got an idea and is acting personally on that idea. So I'm putting my money where my mouth is, but I'm not encouraging anyone to follow me down this path. This is a risky path. I'm taking the risk. I'm not encouraging you to take the risk. I'm not encouraging you to take the plunge with me. Please do your own research. Please look into all of the appropriate avenues to do your due diligence. Consult with a financial advisor, all that good stuff. I don't hold any series license. I don't give investment advice for a living. Just one guy on the internet. Happens to have a little bit of a finance background, just enough to be dangerous, but not enough to be, someone that gets paid for a living to do this. But that said, I do think we're going to see some pretty serious repercussions going forward. So again, guys, thanks for listening. And certainly be monitoring the Fed's movements and what they're doing in terms of running off their balance sheet. But it is a very interesting year coming up for us, and it'll be exciting to see what the Fed ends up doing in 2019 regarding the runoff of their balance sheet. Take care, guys.